If you're looking to buy Nikola Motor stock, then please keep watching this video because we're going to look at the company's recent news, how's the market treating it, and what are the technicals telling us. And most importantly, what would be the best trading approach. As the market remains volatile at the moment, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the previous trading session, Nkla fell by around 5% below the 90 cents level and more importantly, failed to go back above $1, which is the minimum required to stay on the Nasdaq. Over the past month, the share price dipped by almost 50%, whilst over the course of 1 year, it fell by more than 80%. Most of these are due to the continued tendency of the market to gradually sell off tech and EV stocks, even without any potential shorting operations going on, and also without any major catastrophes either. It's not like Trevor is going to be arrested anytime soon, again, right? Because he's already in jail. Because like some trucks has been gliding off a mountain instead of being powered by an actual battery. So this time it seems like the market has moved beyond this point and is looking at the market, like the market cap of Nkla, to be actually a lot better than what it could have been, and frankly, a lot better than what it deserves. The market seems to be far more tolerant with Nkla than with many other companies, say Hyliion. Sometimes when I cover those companies, I used to say one of the few that don't have scandals around them is Hyliion, and yet it's not one of the best priced, right? It's not the one with one of those higher market caps. So sometimes there's some little ironies in the market too. That being said, we always have to remember that Nkla didn't start very well. Like the whole thing felt scammy, and hopefully over time, it managed to chip away this public image. I think that they've partially succeeded, but only partially. So with that being said, let's also take a look at the technicals. The trading volume of Nkla has been around 70 million shares versus an average volume of 63 million shares. Over the previous 52 weeks period, the price fluctuated between 52 cents and $5.60. The volume of shares traded tells us how many shares are being bought and sold at any given time, and if there's enough liquidity to support a trading strategy. If the float is very thin, it's going to be easy to influence the stock price. But low liquidity also means that the demand can be very limited. So when we compare the current volume against the average volume, there could be a possibility for trend reversal. Although in this case, well, I would say that it's not going to happen, and the tendency, whatever it is probably going to maintain at least for the rest of the week. So if the stock were to break through, the current volume would be significantly higher instead of just slightly higher, and vice versa if the stock were about to collapse. But also, mind you, during a collapse, the volume can also increase significantly because there might be people short selling, there might be people who want to scoop the bottom, and so on. The market cap of Nkla is currently around $710 million versus the enterprise value of $780 million. It's currently trading at a very small discount. A discount nevertheless, but a small one, which again is kind of incredible, given how many bad stuff Nkla has gone through. So, as we compare the current price to the historical price fluctuations, the stock is 8% higher than the 1-month low, 8% higher than the 3-month low, and 8% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price went to, the implied volatility is 180% versus a historical volatility of 140%. The put-call volume ratio is currently at 42%, It's normal for most stocks to also have like a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 22,000 contracts a day versus the 30-day average of 139,000. In terms of open interest, the most recent volume of open interest is 2.2 million contracts versus the 30-day average of 2.4 million contracts. Regarding the shareholder structure, institutional owners hold about 23% of the outstanding shares, which, by the way, for a company like NIKOLA, it's incredibly high. The biggest shareholders include BlackRock, Vanguard, and Citigroup. It's always good to see some institutional participation when the intention is long-term investing, because it offers a layer of stability and token reliability in the medium to long term. It means that the market is confident that it'll deliver value in the long term, which is an important factor to consider for the investors. I personally believe that a minimum threshold should be around 25 to 30% for institutional ownership. There are, of course, many exceptions to this rule, as there will always be a lot of great companies owned by retail traders. The current short interest is 21% of the total floats, and 60% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15%, and keep in mind we're at 21% now, there is a case for potential short squeeze. I'm not saying that it's a sure thing, but it's definitely a possibility. And I would argue that if NIKOLA is where it is, meaning still maintaining almost above $1, then there's some of that in the explanation of why NIKOLA hasn't collapsed down to like 15 cents. Fundamentally, it's probably because NIKOLA is a stock that's many people in the market, like a significant number of people in the absolute, believe that the stock will be able to bounce back just because a lot of short positions have to liquidate. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. So, overall, I believe that we should consider NIKOLA like a short term speculation position that deserves our attention, given that it's near its historical low from a medium term perspective, and that a stock like NIKOLA is highly dependent on the current market sentiment. I think that NIKOLA will eventually be able to find another sequence of favorable momentum in order to boost itself. And this is why I believe that a possible entry point could be soon. I recommend to commit between 0.5 to 1% of your portfolio in the stock, and would also recommend to split the allocation in batches of 20% at a time over the next couple of weeks so that you can purchase more if it retraces.